Harvard Business School, PhD in finance. CFA charter, 20 years on Wall Street. Dr. Richard Martinez had every credential that mattered. His investment strategy was a masterpiece of sophistication. Algorithmic trading models, derivatives overlays, sector rotation systems, volatility targeting, currency hedging, tax loss harvesting, 200-page investment committee presentations, Excel models with 10,000 formulas, risk management systems that monitored 47 different variables. His 10-year return, 3.2% annually. Meanwhile, his neighbor Bob, a plumber with a high school education, bought index funds and held them for 20 years. Bob's return? 9.7% annually. What happened? Sophistication destroyed Dr. Martinez. Simplicity enriched Bob. This is the danger of sophistication that Charlie Munger warned about his entire career. The smarter you try to be, the dumber you often become. Complex strategies feel intelligent, simple strategies feel stupid. But in investing, as in life, simple usually beats sophisticated. Not because simple is easy, but because simple is robust. Simple strategies survive what complex strategies cannot. Unexpected events, changing conditions, human error. Munger built his fortune on radical simplicity. Buy great businesses, pay fair prices, hold forever, that's it. No algorithms, no derivatives, no complex optimization. Just 3 rules that any child could understand, but most adults refuse to follow. Today you'll discover why sophistication is the enemy of wealth, why complexity destroys more fortunes than stupidity, and why the path to extraordinary results often runs through ordinary methods. Sophisticated strategies feel intelligent because they require intelligence to understand. But feeling intelligent and being effective are completely different things. Consider long-term capital management, the hedge fund run by Nobel Prize winners and former Federal Reserve officials. Their mathematical models were decades ahead of the competition. They had PhDs in physics, applying quantum mechanics to bond trading, computer scientists building artificial intelligence systems for arbitrage, economists creating models that could predict market movements with scientific precision. Their strategy was so sophisticated that most people couldn't understand it. That should have been the first warning sign. Result? They nearly destroyed the global financial system and lost $4.6 billion in 4 months. Meanwhile, Munger and Buffett sat in Omaha, reading annual reports and buying simple businesses they could understand. No complex math, no sophisticated models, no Nobel Prizes. Who made more money? The complexity trap works like this. Intelligence seeks complexity because complexity feels like intelligence. Simple solutions feel unsophisticated, obvious, beneath our intellectual capabilities. So we add layers, more variables, more models, more optimization. Each layer makes us feel smarter while actually making the system more fragile. Complex systems fail in complex ways. When one component breaks, it cascades through the entire system. When assumptions prove wrong, everything built on those assumptions collapses. Simple systems fail in simple ways. When something goes wrong, you can see what it is and fix it. When assumptions prove wrong, you can adjust quickly. Munger understood that in uncertain environments, robustness beats optimization. Better to be approximately right with a simple approach than precisely wrong with a sophisticated one. But this requires intellectual humility, the recognition that your intelligence might be working against you. Smart people struggle with this because their intelligence has been rewarded throughout their lives. More complex solutions earned better grades in school, higher positions at work, more respect from colleagues. So when they encounter simple solutions that work better than complex ones, cognitive dissonance occurs. It can't be right that something so simple outperforms something so sophisticated, but it often does. Wall Street runs on sophistication theater, the performance of intelligence designed to impress rather than achieve results. Investment committees with 50-slide presentations analyzing why a stock might go up 3% this quarter. Risk management systems that measure volatility to 6 decimal places while missing obvious business risks. Portfolio optimization algorithms that can calculate efficient frontiers but can't identify a good business. This theater exists because sophisticated clients expect sophisticated solutions. Pension funds and endowments won't pay high fees for someone to buy index funds and wait. They want to see complex strategies, advanced mathematics, cutting-edge technology. They want to feel like their money is being managed by rocket scientists, not simple investors. So the financial industry gives them what they want: complexity that justifies high fees while delivering mediocre results. Meanwhile, the simple strategies that actually work get ignored because they're not sophisticated enough to sell. Consider the difference between two approaches. Sophisticated approach: multi-factor models that analyze 127 variables to predict which stocks will outperform. Dynamic hedging strategies that adjust exposure based on volatility forecasts. Alternative investments including private equity, hedge funds, and structured products. Simple approach: buy low-cost index funds, rebalance annually, hold forever. Which sounds more impressive? The sophisticated approach. Which performs better? Usually the simple approach. But sophistication theater continues because it serves psychological needs beyond performance. It makes people feel smart, important, in control. Munger never participated in this theater. Berkshire's annual reports are models of clarity. Their investment process can be explained in 3 sentences. Their meetings focus on simple questions. Is this a good business? Do we understand it? Is the price reasonable? No sophisticated models, no complex presentations, no theater. Just simple questions leading to clear decisions, producing extraordinary results. Silicon Valley engineer turned day trader, Mark spent 6 months building the perfect trading system. Machine learning algorithms analyzing technical patterns, natural language processing scanning news sentiment, network analysis tracking insider movements. Real-time data feeds from 17 different sources. The system could execute trades in milliseconds, adjust position sizes based on volatility, hedge currency exposure automatically. 6 months of coding. $50,000 in development costs. A technological masterpiece. First month return, negative 12%. Meanwhile, his wife bought $10,000 of S&P 500 index fund and forgot about it. 1 year later, Mark's sophisticated system had lost 40%. His wife's boring investment was up 15%. This is over-engineering the tendency to solve simple problems with complex solutions. Engineers are particularly susceptible because engineering rewards optimization. In technology, more features usually equal better products. More code enables more functionality. But investing isn't engineering. More complexity doesn't equal better performance. In fact, it usually equals worse performance. Every additional variable increases the chance of error. Every extra step creates another point of failure. Every optimization makes the system more fragile. Munger saw this constantly. Brilliant people applying engineering principles to investment problems that didn't require engineering solutions. The stock market isn't a machine to be optimized. It's a complex adaptive system, influenced by human psychology, political events, natural disasters, technological changes. You can't engineer your way to predictable returns because the market is fundamentally unpredictable. But you can position yourself to benefit from this unpredictability through simple, robust strategies that work across multiple scenarios. Munger's approach. Instead of trying to predict what will happen, build portfolios that profit from good outcomes and survive bad ones. Instead of optimizing for maximum returns, optimize for minimum regret. Instead of building complex systems, build simple processes that you can follow consistently for decades. This requires resisting the urge to over-engineer solutions to problems that are better solved through patience and discipline. Modern finance theory is sophisticated, mathematically elegant, and mostly useless for actual investing. Efficient market hypothesis assumes markets are perfectly rational. Capital asset pricing model assumes risk can be measured by volatility. Modern portfolio theory assumes returns are normally distributed. All beautiful in theory, all problematic in practice. Munger never bought into academic finance because he studied actual markets, not theoretical ones. Real markets are driven by fear and greed, not rational calculation. Risk comes from business fundamentals, not price volatility. Returns come from buying good businesses cheaply, not optimizing correlation matrices. The academic illusion persists because sophistication sells. MBA programs need complex curricula to justify high tuition. Finance professors need mathematical models to publish papers. Investment firms need sophisticated theories to charge high fees. But complexity doesn't equal accuracy. Mathematical elegance doesn't guarantee practical effectiveness. Consider the difference between academic and practical approaches. Academic. Calculate optimal portfolio weights using mean variance optimization based on historical correlations and expected returns. Munger. Buy businesses you understand at prices that make sense. Academic. Measure risk using beta, standard deviation, value at risk, and other statistical metrics. Munger. Avoid businesses with obvious problems and management you don't trust. Academic. Diversify across asset classes using correlation analysis to minimize portfolio variance. Munger. Concentrate in your best ideas and avoid businesses you don't understand. Which approach sounds more sophisticated? The academic one. Which approach has produced better long-term results? Munger's. The problem with academic finance isn't that it's wrong, it's that it's incomplete. It captures mathematical relationships while missing human psychology, business fundamentals, and common sense. Munger integrated insights from psychology, history, business, and common sense into a simple investment philosophy that worked better than any academic model. Because real markets require practical wisdom, not theoretical sophistication. Here's what most investors miss. Simplicity isn't the absence of sophistication, it's sophistication distilled to its essence. Einstein said, "Everything should be made as simple as possible, but not simpler." Munger applied this principle to investing. Remove everything non-essential until only the fundamental truths remain. What remains? 3 simple rules. Rule 1. Buy businesses, not stocks. Rule 2. Buy them when they're selling for less than they're worth. Rule 3. Hold them until they're no longer great businesses or no longer cheap. That's it. No complex formulas, no sophisticated models, no advanced mathematics. Just 3 rules that a child could understand, but most adults refuse to follow. Why refuse? Because simple feels too easy. If wealth building were this simple, wouldn't everyone be rich? The answer is no. Because simple doesn't mean easy. Understanding the rules is simple. Following them consistently for decades is extraordinarily difficult. It's simple to buy great businesses. It's hard to wait for them to become cheap. It's simple to hold forever. It's hard to ignore daily market fluctuations. It's simple to focus on business fundamentals. It's hard to resist exciting trends and hot tips. The simplicity edge comes from the gap between understanding and execution. Most people understand what works. Few people can do what works consistently for long periods. Sophisticated strategies feel easier because they provide the illusion of control. When something complex fails, you can blame the model, the data, the market conditions. When something simple fails, you can only blame yourself for not following the simple rules. This psychological pressure drives people toward complexity, even when simplicity works better. Munger resisted this pressure by focusing on results rather than process. He didn't care if his approach seemed unsophisticated as long as it generated superior returns. He understood that in investing, style points don't matter, only results matter. And the simplest approaches often produce the best results. Occam's razor. When multiple explanations exist, the simplest one is usually correct. Munger applied this principle to every investment decision. When multiple strategies exist, the simplest one is usually most effective. Why? Because simple explanations capture fundamental truths, while complex explanations often capture noise. Consider two explanations for Amazon's success. Complex explanation. Amazon succeeded because of their sophisticated recommendation algorithms, advanced logistics optimization, dynamic pricing strategies, machine learning infrastructure, cloud computing synergies, and network effects from marketplace dynamics. Simple explanation. Amazon succeeded because they focused obsessively on customer satisfaction. Both explanations are true, but the simple explanation captures the essence, while the complex explanation captures the tactics. When evaluating investments, Munger always looked for simple explanations of success. Coca-Cola. People like the taste, and it's available everywhere. See's Candies. High-quality chocolates with strong brand loyalty. Geico. Lower costs enable lower prices while maintaining profits. No complex theories. No sophisticated models, just simple business logic that anyone could understand. This approach worked because simple business models are more durable than complex ones. Businesses based on fundamental customer needs survive technological changes, economic cycles, competitive pressures. Businesses based on complex arbitrage opportunities or sophisticated financial engineering disappear when conditions change. The Occam's razor principle also applies to portfolio construction. Complex approach. Multi-asset portfolios with tactical allocation overlays, alternative investments, dynamic hedging, factor tilting, and risk parity weighting. Simple approach. Buy a few great businesses and hold them forever. Complex approach. Quantitative models that optimize risk-adjusted returns across multiple time horizons and market regimes. Simple approach. Don't lose money. The simple approaches work better because they're based on timeless principles rather than temporary market conditions. Munger built his fortune by consistently choosing simplicity over sophistication, even when sophistication seemed smarter. Here's the final paradox. Embracing simplicity is the most sophisticated thing you can do, because simplicity requires wisdom to distinguish essential from non-essential, intelligence to see through complexity to underlying truth, confidence to ignore sophisticated noise. Most people add complexity because they lack the wisdom to subtract it. They use 10 metrics when 3 would work better. They build models with 50 variables when 5 capture most of the signal. They create strategies with dozens of rules when 3 principles would suffice. Munger spent 99 years learning to subtract rather than add, to simplify rather than complicate, to focus on what matters and ignore what doesn't. This liberation of simplicity creates multiple advantages. Clarity. Simple strategies are easier to understand, implement, and communicate. Robustness. Simple systems have fewer points of failure and adapt better to changing conditions. Consistency. Simple rules are easier to follow consistently over long periods. Peace of mind. Simple approaches reduce anxiety about complex moving parts. Better results. Simple strategies often outperform complex ones over time. But achieving simplicity requires discipline. The discipline to say no to sophisticated opportunities. The discipline to stick with boring strategies. The discipline to resist the siren call of complexity. In a world that rewards the appearance of sophistication, choosing simplicity requires courage. The courage to look unsophisticated while achieving sophisticated results. The courage to use simple methods in a complex world. The courage to trust that the most powerful truths are often the simplest ones. Munger had this courage. For 99 years, he chose simplicity over sophistication, substance over style, results over recognition. The result? One of the greatest investment records in history, built on the simplest possible foundation. The lesson is clear. In a sophisticated world, simplicity is the ultimate sophistication. The question isn't whether you can understand complex strategies. The question is whether you have the wisdom to choose simple ones.